They are panicking. I'm your host, Steve Metre, and thanks for joining me today. And our lead story today, they're out of cash as these banks are dumping everything as they're on the brink of failure. We'll show you which banks and why the situation they're facing is going to get much worse. But they're not the only ones that are running dry on cash. We see corporations and even worse now, consumers. And get this, even one government is now saying they're running out of money. We said this would happen, and this is bringing us to an unthinkable situation, as you're about to see. Plus, we have a sponsor for today's show, Pluri Incorporated. You can find them on the NASDAQ under the symbol PLUR, and their stock has entered a bull market. If you're a technical trader, you're going to love this because their stock has moved over all of their major moving averages and is getting ready to shoot higher. They're a global leader in 3D cell expansion technology in the areas of pharma, food, and agricultural technology, and get this, including coffee. Stay tuned to the end of the show or check out the pinned comment or description for more information. We'll show you an incredible chart setup that should see their stock jump as much as 47%. Now, let's head over to Goldman, where we find out why these banks are unloading everything as quickly as possible. Because we see there's a commercial real estate crisis that is brewing and starting to pick up steam, as Goldman notes there are now $4.7 trillion of outstanding commercial and multifamily mortgages. This according to the Mortgage Bankers Association's 2023 Commercial Real Estate Survey of loan maturity volumes. And this is a big issue because what's the problem with these banks, particularly the small and mid-sized regional banks, is they're upside down on these loans. By raising the federal funds rate aggressively and driving short-term rates up, this has put the banks in a situation where they have massive unrealized losses, not just on their treasury securities and their mortgage-backed securities that they hold, but on their loan portfolio. This is a problem because underneath this, we've warned this was going to happen. The banks are seeing it now, and they want out because the problem is if they don't get out, we could see hundreds of bank failures. And more specifically, in 2024, $929 billion of commercial real estate mortgages are expected to mature, and approximately 20% of the $4.7 trillion total in commercial mortgages outstanding. In terms of property type, we're looking at multifamily and offices. They account for 27 and 22% of commercial mortgage maturities in 2024, respectively. In terms of the lender type, get this, banks hold 47% of debt maturity this year, followed by commercial backed mortgages at 25%. And guess where a lot of this debt is held? Well, if you're thinking in the small and mid-sized regional banks, you got it. Believe it or not, the large banks, they don't hold a lot of these office loans at all, putting all of the problems on the lenders that we already know are insolvent. And among the loans backed by office properties overall, 25% is expected to come due this year. And so what's happened is we've kicked the can down the road from last year, extending some of these loans. And now what's facing is a massive wall of maturity on these loans. And this is an issue because rates are still high. And we're likely to hear from the Fed this week on Wednesday that they're not going to cut the funds rate. But as you're going to see, at some point this year, they're going to have to aggressively cut the funds rate because hundreds of banks could fail. And $1 trillion, of course, in 2024 commercial real estate maturities could lead to hundreds of bank failures. This headline from Zero Hedge, as policymakers are calling the roughly $1 trillion of commercial real estate debt coming due this year, quote, manageable, may end up regretting it. Now, we've heard this before from political elites and policymakers that certain things are manageable or not a big deal, and then they turn out to be a really big deal. And the issue stems here that the banks are not originating a whole lot of new loans. In fact, they're not originating enough to deal with the amount of loans being paid off. The second issue, again, they're upside down. They have massive unrealized losses. At a point, they need cash. And what did the Fed do? Well, they cut off the Bank Term Funding Program. We're going to find out. We said the next banking crisis could start sometime in March. Well, here we are. And here we know that Bloomberg markets reporter and strategist said if defaults topple hundreds of U.S. banks, as pessimists predict, predict the impact on markets and the economy would be tumultuous. Actually, it's going to be worse than that. It would drive us into an all-out financial crisis. Can you imagine hundreds of banks failing and how consumers and depositors would handle that? You're talking about an all-out credit freeze. You're talking about people stopping spending money. You're talking about the inability to use their credit cards because their banks are failing, and then they're worried about moving their deposits. And all of this, it would be outright pandemonium and send us deep into a bear market. And so to get away from this, banks are frantically trying to offload that debt, selling at a steep discount to opportunistic buyers like Fortress Investment and Marathon Asset Management. The CEO and chairman of Marathon says hundreds of small regional banks could fail if defaults accelerate, and that's the challenge. We've been making the case on the show why defaults are likely to increase. We're going to show you some charts which validate that it's only going to get worse. Many people look at the equity markets and say, no, the soft landing happened. The worst is behind us. No. The stock market's giving us a false signal here. We're going to see a massive increase in debt defaults, as you're about to see, and it's coming not just to the banks, but to the consumers as well. And the issue here is a bank run of that magnitude would have a significant implications for regulators and policymakers because hundreds of U.S. banks could go bust. And that is an issue because we know the impact and the number of banks going insolvent already are high because of all the money they borrow from the Fed. And then we come back to the delinquency rate for loans backed by offices has jumped to 6.5% at the end of December from 5.1% 3 months earlier, this according to the Mortgage Bankers Association. So we talk about this issue that everybody thinks we're going to see a soft landing or no landing scenario, and yet we continue to see the percentage of defaults, whether it's on credit cards, now we're seeing it on mortgage office buildings, is increasing. That is not the indication of a soft landing at all. What this tells us is there's going to be a massive financial crisis centered on these small and rich-sized regional banks that are holding a massive amount of these loans. The share of office loans that are distressed, get this, rose to 11% in February. So we're talking not only the delinquency rates, we're talking about loans that are expected, are missing payments, late on payments, or that are expected to enter delinquency. The stress rate is rising. It's only going to get worse. And this is the highest in at least 18 months. So again, the notion of the soft landing or this no landing scenario is not happening at all. And yet we'll hear on Wednesday from Fed Chair Jerome Powell that we've likely declared victory here, and they'll only need to cut the funds rate maybe 1 or 3 times by the end of the year. The reality is, once this commercial real estate banking crisis goes all out, they're going to be back at zero, and that won't be enough to solve it because the issue here is it's too late. If we take a look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, this shown in blue, against the delinquency rate in red. And as we talk about in a debt-based economy, what you typically happens is new loans are taken to pay off old loans, and this happens all the time. So when banks start to tighten lending standards, well, that constricts not just the creation of credit, but it also limits the amount of new loans that are originated. When that happens over time with a lag, as we look back at the chart here, what happens is the delinquency rate starts to go up because the financial system is constricted of enough money that it needs to pay on all the debt and support growth. Here you can see as banks tighten lending standards, what happened, the delinquency rate that's shown on all commercial loans at the banks goes up. You see it during the global financial crisis, and you see that now this data is based on a quarterly rate, so we don't have the newest data, but based on what we know from the Mortgage Bankers Association, this is rising. This is not the trend you want to see at all, and this is going to affect other things as well. Because when we look at the commercial industrial lending data, this on a weekly basis, we've been talking about how this is in contraction. As many of you pointed out in the comments, does indeed lead to recessions, as you can see it here. In some cases, all-out financial crises, because the case is new money is created when banks originate loans. So on net, you need more loans created than are being paid off, so that way you have a net creation of money. So in this case, the banks are also now destroying money as more loans are being paid off than originated. And you come back to the delinquency rate and you see the trend is very obvious here. As lending decelerates and then contracts. What happens? The delinquency rate goes up. You see that going back into the 90s, into the early 2000s, going to the dot-com bubble, of course, going into the global financial crisis, even heading into the pandemic as we saw a deceleration in credit going into that. And then now we're seeing this happen again, and yet nobody actually believes it's happening. We've said this was likely to, and here it's starting to play out. This means small banks could fail, and we're talking hundreds of them to make things worse. And yet, on Wednesday, we'll likely hear from Fed Chair Jerome Powell and this press conference. And here we can see Treasury Secretary Janet Yellen. They both are saying, hey, this isn't a big deal because there seems to be ample demand for risk that would absorb any shock. Well, I can tell you this, there isn't anything that's going to absorb hundreds of bank failures, and capital markets, they believe, are buoyant. In addition, the belief is that only the smallest banks are in jeopardy. The latest storm is likened more to the 1980 savings and loan crash than the 2007 to 2009 global financial crisis. That would be outright dangerous. And in a day and age where consumers have access to electronically transfer their funds, not only just between accounts, but between banks, we've already seen what happened a year ago, how fast money can move and accelerate bank runs. You can only imagine if one and then two, and you start to see the dominoes fall of banks fail, how fast money is going to move and accelerate the failure of the system. Again, even getting back to zero won't save it. And as you can see, of course, the Fed normally reacts to rising delinquencies. On Wednesday, we'll hear the Fed not do anything, but notably the federal funds rate in blue, again, you see against the delinquency rate in red, that as delinquency rate rises, the Fed tends to cut. And again, it comes back to how the system works. You need lower rates to spur people to borrow to cover up those bad loans. Again, in our system, we're always covering up prior loans, bad debts. It's just how the system works. And you can see this relationship happen over and over again. As delinquency rise, well, the Fed starts to cut rates. You see it happen going in the global financial crisis, and now we're going to see them forced to cut again because once delinquencies start to pick up steam, you generally can't stop them. And cutting rates a couple times isn't the magic sauce that's going to fix it. In fact, weak companies that rely on bank funding will suffer directly if lending standards tighten. Well, guess what? They're already tight and likely to get worse, particularly as defaults increase, because the one thing banks care about the most is getting their money back. So when more of their loans go into distress or into delinquencies, they start to believe that others are, and they curtail their lending activities even more, just exasperating the scenario. And if also a spike in commercial real estate defaults pushes up funding costs across the board, of course, that will happen too. In addition, trouble is not confined to the U.S. Germany, Sweden, Austria, and South Korea are also countries of concern. This isn't a U.S. issue. It's a global issue. And just as cities Chuck Prince probably rues the days as he told Financial Times that he was, quote, still dancing back in 2007 before subprime erupted. Policymakers will likely end up regretting being so late to blaze about this year's commercial real estate mess. This is, again, the biggest time bomb under the banking system, and now we're starting to see it come to roost. We kicked the can on some of these loans from last year into this year, but you can imagine 25% of these are going to be renewed. We're already seeing an increase in delinquencies and loans that are behind, running into problems. This is only going to get worse, and in a big way. But as they started to show out, it's not just banks that are running out of money here. It's also corporations, and as you're about to see, consumers. Because wages in the U.S. are falling at a striking pace, this according to Indeed. And of course, if we are going to see wage increases, that means corporations have tons of money and they have demand for, of course, for their labor market that they have to push higher and higher wages on. This is changing, and this is going to affect consumers who are going to default on more of those loans in a big way. As the wage tracker based on salaries for job advertisements listed on Indeed showed the salaries were up 3.3% in February compared with the same time about a year ago. That's a marked drop from January of 2022. Wages were up about 9.3%, suggesting employers are facing less competition for new hires because demand for the economy is going down. We see more people on unemployment, despite the fact that the government, the Bureau of Labor Statistics, tells us there's all these jobs being created. Well, that's not actually how it's panning out, because employers are not seeing the robust labor market the government is seeing here at all. In fact, the pace of deceleration is striking. Posted wage growth has fallen by almost 3 percentage points over last year, and this is a trend that's going the wrong way. And while the deceleration is broad-based, it is most pronounced in the lowest wage sectors. Posted pay for that group trembled to 3.4% in February from 12.5% at the start of 2022. And as inflation still stays high and demand for wages continues to slow, that means consumers have less money to spend to keep up with inflation, less money to spend on the discretionary side of the economy, and that just adds to the whole slowdown and fuels the banking crisis. And given the run-up in posted wages for those sectors, wage growth is still above its pre-pandemic pace. How long this will last remains uncertain. But by comparison, wage growth for high-wage employees dropped from a high of 8.2% to 6.2% in February. For middle-wage workers, year-over-year growth has fallen to 3.9% from a peak of 8.5%. And when we look at average hourly earnings of production and non-supervisory employees against the delinquency rate on consumer loans, that in red, and on credit card loans in green, what we can note is now when we start to see decelerations in wage growth that tends to equate to an increase in delinquency rates. It was more pronounced during the global financial crisis, and it's beginning now, because what it validates is that indeed consumers do not have the money to pay on debt and maintain their lifestyle and keep pace with inflation. They're being forced into delinquencies. So you look at the banks, they're going to get hit by commercial real estate and by consumers at the same time. And there are growing signs the labor market is beginning to weaken in the face of higher interest rates and stubborn inflation. There's been a wave of notable layoffs since the start of the new year, and the list is growing stronger by the day. And it makes sense, because if employers do not have to give out big wage increases, it's because there's slack in the labor market the government can't see. We can look at continued claims here, and we note there as they increase in red, that matches a deceleration in wage growth. That's exactly what we're seeing right now, setting up the banks for a massive crisis, one that they cannot stop, when the 0% interest rates won't fix. The Fed is too late here, because the labor market has remained historically tight over the past year, but that's changing, and because economists now anticipate the labor market will continue to slow in the coming months as higher interest rates work their way through the economy. It has nothing to do with higher interest rates. It has everything to do with the fact the banking system isn't creating money. Here you can see again net percentage of domestic banks tightening standards for commercial industrial loans in blue on net when they're tightening. This against average hourly earnings of production and non-supervisory employees in red. That means there's less money in the economy, less demand, and less need to pay employees as much. You see those decelerations happen every single time. And this is all turning into governments running out of money. Now Germany has said, we're out of money now, and debt levels are exploding, and this is leading to the unthinkable. I told you this was going to happen. You're seeing it right now in real time, as the German finance minister is warning his own government that the state finances are quickly growing out of hand, and the government needs to change course and implement austerity measures. Could you imagine? They're headed into recession, and they have to implement austerity. However, the dispute over spending is only expected to escalate, with budget shortfalls causing open clashes among, of course, the political elite. And under EU law, Germany has limited its debt levels to 60% of economic output, which requires dramatic savings. A huge factor is Germany's rapidly aging population. Think about the U.S. here. We're going to follow this path. I'm warning you now, with debt explosion on the horizon, as more and more citizens head into retirement while tax revenues shrink and the social welfare system grows. This is an issue, because here you can see the headline: Germany is in a recession due to first quarter slump. This is dangerous. What this means is countries around the world are going to force to enter austerity at a time of a globally synchronized recession. Talk about dangerous stuff going on here, but something that is in a massive bull market and looking to roar higher. That is the stock of our sponsor of today's show, Pluri Incorporated. Again, you can find them on the NASDAQ under the symbol PLUR. Check out the pinned comment and description for more information. Let's take a look, because they transform cells into solutions that promote global well-being and sustainability. They offer robust cell expansion technology platforms that create new cell-based solutions, and their technology has the potential to improve the quality of life and make the world a better place. Something else we think is going to make it a better place, that is your trading account. Again, check them out on the NASDAQ, PLUR. We're going to look at some charts here in a moment, but they've got cash, $31 million. As of the end of last year, they've got a rich intellectual property portfolio with 140 patents granted. They've got their own manufacturing facility, and they're focused on 4 industries: the health, food, contract development, and ag tech. And look at some of their partners: the Department of Defense, NASA, the Food and Drug Administration, just to name a few. That is impressive. And what else is impressive is their technology advantages. They've got patented proprietary 3D cell expansion technology to produce high quality cells. They're scalable, they're cost effective. And again, they've got the manufacturing process approved by key regulators. Let's check this out, because their potential applications are almost endless, and any industry that requires mass cell production can be potentially benefit from Pluri's patented technology. And again, we talk about things that can benefit. How about the coffee industry? It's in a crisis, as coffee production will be decreased by half in the next 30 years, and this is causing import prices to rise by over 65%. And we've seen a land suitable for growing coffee will reduce by 50%. By the year 2050, this is an issue that Pluri has got a solution for. They've created sustainable coffee. They've got patented coffee cell technology. It's eco-efficient, mass scalable production, and they've got the experience, 2 decades of experience to name that. But let's talk about their stock now, because this thing is in a bull market. If you're a technical trader, this is a dream setup. Stock is trading above all its major moving averages and looking to break higher. Put it on your trading screen, symbol PLUR on the NASDAQ. Let's take a look at the 2-year chart. You see the volume profile line of it kind of drawn it in here, and you see down here that buyers have been accumulating shares, and now it's starting to break out. And you notice it's sitting right in the supply zone. This is where sellers have been, and they've shown up. You see the sellers back here, and this is creating a short squeeze that could force all of these shorts that drove the stock way down to come shooting higher up into this upper zone. You've seen it happen before. It did, going back here into 2022, where the stock took off. And let's zoom in, because this is the potential. A 47% move upwards into the supply zone is what we're expecting. And you can zoom in to the 10-day chart. What do you see? Extending that volume profile line along the edge. What do we know? Buyers are accumulating under here, looking to squeeze those shorts in a big way. And as you can see, because they're trading above their moving averages, their stock's in a bull market. This is getting the attention of traders and investors in a big way, because people are loving what Pluri is doing, and we think you're gonna love what it does to your trading account. And with that, I'm Steve Van Metre. As always, when any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, again, I'm Steve Van Metre. Thanks for watching. Thanks for following. Bye now.